Hello and welcome to Swag Academy. In this video I will present to you Peter Lynch's strategy and framework. Peter Lynch had an interesting view to categorize different types of stock. I will discuss this as well as his stock selection criteria. Before we start, Peter Lynch was one of the best investors worldwide. His fund grew by 30% annual compound rate for over 10 years. Let's begin. Peter Lynch gave stocks 6 different categories. The first one is slow growers. These are large companies that are aging and growing at a slightly above GDP growth. The second one, which he calls stalwarts, represent large companies that are slowly growing and offering good but not great returns. Coca-Cola is an example here. The company grows is 6 to 7% every year. Good but not exceptional. The third category is fast growers. These are companies that are aggressive and gaining market share. These companies are growing at a 20 to 25% annual growth rate over longer period of times. An example is the company Celsius Holding. If you are interested, make sure to watch the stock analysis video I made on my YouTube channel. The fourth category is cyclicals. These companies' sales and profit rise and fall with the economy or their own cycles. Companies like energy and oil stocks. The fifth category are turnarounds. These are stocks that are battered now and will have a comeback later. Alibaba is an example, and so was Meta a couple of years ago. The stock of Meta went down to $90 and now it is around $500. The last category are asset plays. These are stocks with hidden assets and a rich balance sheet. Hidden assets can be cash, a stock portfolio, or real estate. The next aspect of Peter Lynch framework is the stock selection criteria. The first area is market capitalization. Peter Lynch preferred his small cap companies because of their longer growth runway. Peter Lynch says big companies have small moves. Small companies have big moves. Lynch, however, did not define in his book what the minimum or maximum size of a company is. I recommend companies with a market cap of at least $500 million. The second selection criteria is the price-earning multiple, or the PE ratio. An important metric like this cannot be looked at in isolation. This is why Peter Lynch did study it for several years along its industry average to see if the company is in a debacle. So here you can apply 2 criteria. The first is to have the company PE ratio lower than the average 5 years PE ratio, and the second is that the company's PE ratio is lower than the industry's PE ratio. The third criteria is earning growth. Peter Lynch preferred companies that are growing at a rate of 15 to 25%. So here you can search for companies with a 5 years compound annual growth rate higher than 15%. The fourth selection criteria is the PEG ratio, or the PE to growth ratio. The PEG ratio is the PE ratio divided by the earnings growth of a company. So if a company have a PE ratio of 30 and is growing at 10% per year, then the PEG ratio would be 3. Peter Lynch says in his book the PE ratio of any company that is fairly priced will equal its growth rate. So Peter Lynch was looking for a PEG ratio of 1 or less. The fifth criteria is a strong balance sheet. Peter Lynch is particularly referring to the amount of debt in the company's balance sheet. This is where a debt ratio of less than 25% is recommended. The sixth criteria is institutional ownership. Peter Lynch prefers companies where this number is on the low side. So the criteria is that we are looking for a company where the combined percentage of domestic and foreign institutional holdings is less than 20%. The 7th and 8th criteria is based on Peter Lynch experiences, where he lists the kind of businesses he prefers or avoids. Lynch preferred companies with a boring name, companies that are operating in a boring industry, ideally a spin-off because these receive little attention, niche companies that control a large part of the market, companies whose products are always in demand, insiders are buying shares. Now for the businesses he tried to avoid, hot stocks and hot industries like Tesla and Nvidia, companies with big unproven plans, profitable companies who are diversifying and acquiring into other industries. He called it diversification. Companies where one customer accounts for 25 to 50% of the clients. So these 8 criteria form the basis for Peter Lynch's stock selection criteria. And if done well, this can be the basis for your small cap multi-bagger strategy. I hope you found value in this video. If yes, please give us a like and consider subscribing. Thank you very much for watching.